Now let me scroll down here. I want to show you this. And just kind of what he did, people realized that it was too risky. And a lot of people don't go this deep into this. A lot of times, hi, I'm John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today is a little different. I've got one of my clients I just helped with an annuity, and he wanted me to share his story with you. So he spent $550,000 to give himself $53,000 in guaranteed lifetime income forever. Okay. He's single. He doesn't have kids. He doesn't care about legacy. He didn't use all of his money. He thought this out quite a bit. I mean, he analyzed every single number you could possibly think of, and he still figured out at the end of the day that buying the income rider was absolutely the best he could possibly do to guarantee that he has the highest lifetime income and reduce the stress, especially when he was looking at a safe withdrawal rate, which was much higher than 4%. It was like 7%. It was still the best option for him. And so I'm going to share my screen. I'm going to show you a lot of different options, but I want to share with you some of the things that he shared with me, and just kind of what he did to decide that the income rider was the best. And a lot of people don't go this deep into this. A lot of times when people are looking for annuities, they'll throw money into it and they're like, I'm looking for lifetime income. What's the highest payout? Which is great. That's what most people will do. But he really wanted to make sure it was the right decision. And so I wanted to share his experience and kind of what he came up with. And I want to share it with you because that might help you in your annuity purchase as well. Now, again, if you want to look for annuities, okay, if you want to look for the highest payouts, okay, don't take my word for it. Don't take your advisor's word for it. Just go to a calculator and find out for yourself. I happen to have annuity calculators that get their feeds directly from Canex and Annuity Rate Watch from all the carriers, and it shows you all of the highest payouts. So go to my website, johnstevenson.com. You will see all of the annuity payouts for you personally, and if you're married, it'll show the payout for a joint payout as well. And then if you want to reach out to me, you can book a Zoom call. There is a link right on my website there, or you can go to the link right below this video and book a call with me there as well. I'd love to help you buy an annuity if that is what you're looking for. And if you just got questions, comment below. I'd be happy to answer them. But again, I don't try to hard sell people into these products, but I do like to show you everything that's available. And I'm also going to talk about commissions, because this annuity that I sold him was lower commissions than another that I could have sold him that would have given him less income. Okay, so that's really, really important. If you're looking for someone you can trust, someone who's transparent, then you should probably talk to someone who's willing to show you everything. So now, let me share with you what he's doing. Okay. And he's looked at a lot of different strategies. He's used the Monte Carlo. You're probably familiar with that. He really has done a deep dive. Okay, so I'm going off my notes here. So he's got a $1.1 million portfolio balance. Not bad. Okay, he is 69. He's almost 70, and he's planning on a retirement length of 25 years. Okay, he might live longer than that, but this is just, for comparison purposes, that's what he's looking at. Okay. Now, what he really wants to do is he wants to get $78,000 per year in income. And the only way for him to do that, and I'm just reading my notes here, he says a 7.1% withdrawal rate. And he says it feels way too risky to me, which I agree. 4%, in my opinion, is too risky. In fact, that's been debunked. I mean, that was the standard until people realized that it was too risky and they lowered it to like 2%. And most of us are like, I cannot live off of 2%. I mean, unless I got like $50 million, right? Which most of us don't have that. And so he says, well, I bought a $550,000 income rider that provides $53,000 annually guaranteed, okay? And the remaining $550 balance, he says it's going to remain invested. And then he's going to apply a safe withdrawal rate of 4.5% as needed. And so for him, that feels a lot more comfortable, and he can leave it in the stock market and let it grow a lot more aggressively. Okay, so by combining these two strategies, he says my annual income goal has been met in a much safer way. Okay, so instead of applying the 7% withdrawal rate to his portfolio, he's able to give up a little bit of liquidity and allow it to give you this massive amount of lifetime income. That's what it's for. So, and that's what he's doing. So he looked at this and he said, even with this dual-pronged strategy, he says very likely result in a greater ending portfolio balance than the high withdrawal rate approach, because he might live longer, right? So he says also gives more flexibility, then I can monitor portfolio performance, and when the market is up, I can make all the additional discretionary withdrawals to meet surprise expenses, such as luxury spendings and just any splurge withdrawals that he wants to do. Okay. And then he goes on, he says, all right, now just to make sure I was comfortable with the income rider, I analyzed another strategy, which a lot of you do this. Okay. And I'll show my screen. I want you to see this here too. And I want you to see commissions too. But what he did, he put the $550,000 initial investment and he put it into annual maturities and he spread it out 10 years. So I said for simplicity, I assumed a 4.25 rate for all maturities. So this is close to the current market rates, calculated the principal amount needed for each annual maturity, such as when combined with the interest for that year. The desired $53,000 annual cash flow incurs. In other words, each $53,000 annual cash inflow is a combo of maturing principal and interest for that year. Okay. So after 10 years, $190,000 of the principal remains. And if we assume it is invested at the same 4.25% rate, the same $53,000 is pulled annually, it will last exactly 4 years. At that point, both income and principal are depleted to zero. Income rider, of course, principal will also be likely depleted. Now that's also something to note. But at that point, it is income. Of course, it continues forever because it's a contract, right? And the latter strategy gives it to you for 14 years. Isn't this interesting? I mean, there's a lot of different ways to create income for yourself. You can absolutely keep your money in your portfolio and take whatever withdrawal rate you feel comfortable with. But I'm telling you, no matter how comfortable you feel with it right now, when you got a couple years where we have a recession or we got market downturns that are not great, you're not going to feel good. You're going to be stressed out and your retirement experience is not going to be as great as you were hoping it's going to be. And that does happen. It's a certainty. We know the market will retract at some point. And sometimes it's for a long time. And we just don't know when it's going to happen. And so to protect against that, to have a safer withdrawal rate, as he was talking about, he bought an annuity with half of his balance. And it's going to work out really, really well for him. And so I wanted to show you though, what I was showing him. So you can go to my calculators, you can find out for yourself, but for him and his particular situation, okay, he's in North Carolina, he wanted to put $550,000 in and he wanted to wait 1 year to take income. So it's deferred for 1 year. All right. So let's look at my screen. You'll notice here, we've got his annuity pulled up right here. And it's almost $53,000. He rounded up. So it's $52,668. And you can see he is 69 years old, North Carolina, 550. He's going to take income at age 70. Okay. And you'll see this is with National Western Life. And they're the highest payout, $52,668. Then you got Delaware. Then you got Nationwide. And you got Global Atlantic and all these other ones, F&G. Great companies, okay? Absolutely good companies. But I'll tell you right now, when I go to this, I'll show you the income here. See that? $52,668. Guaranteed. You see this? This shows worst case scenario because the insurance company is buying call options associated with the S&P index. And if they experience growth, which they will, he's going to get some of it. Not all of it, but he'll get some of it. And that'll just accrue to his account balance and just make it last a little bit longer. But they're showing you worst case. If there's no growth whatsoever, like so we have a long extended recession, then that's fine. His account balance will run out by the time he's 80, but the income continues for the rest of his life. Okay. Then they show you, here's what it will look like if we give you some of the earnings. Okay, your account balance will last a few more years. Okay, but it still runs out and you'll take that income out. And if you live till 98, you're going to take out $1.5 million in income. It's that simple. If you live longer, you take out more. So, and it was a great strategy for him. So now let me scroll down here. I want to show you this. A lot of guys will not show you this. I'm going to. A lot of people are afraid when you ask them how much money they're making. I don't care. It's like if you're going to work with someone, you're going to have a relationship with them, you might as well have full transparency. Show commission. See that right there? 5%. Bam. Made 5%. Okay. Now, if I went down here and I said, well,
you really should buy Nationwide.
And, it's a great company. And they are a great company. And the payout's still good, but he's sacrificing some income. So I can illustrate that and say, okay, this is what I recommend. Nationwide's a great company, and they are a great company, and I can say, the rating's A+, you should do it because of A+ rating. Okay, 7%. All right. So, I could have made a little bit more. Heck yeah. That's great, right?
550,000 times 0.02. I would have made an extra $11,000. Darn it, right?
No, come on. Things even out. And so all of these pay me 7%. So I wish the other ones would show up, but they're not. So anyways, I wanted you to see that because it's just important for you to see that sometimes the highest income for you is not the best for the advisor. You know, if I'm still making great money with this, but I could have made another $11,000 if I could have sold them in any of these. But I showed him everything. And when you go to my website, you'll see everything that's available on there as well. And again, if he was to wait longer, I mean, he could definitely wait longer. If he waited till 73 to take income, he could absolutely take more income. And you know, my calculators will show you everything that's available. In this case, Delaware is the highest, and they're paying higher commissions too. But you know, he could absolutely choose this one down here. But this one here is paying him the most in 1 year, and he's not going to wait longer than a year. But if he's waiting longer, they're not the highest payout for waiting longer. The highest payout would be Delaware. Okay, so that's why I'm saying it all evens out. And it's really best, instead of being a product pusher and pushing just one company, one product all the time, which I know agencies, they will push one company, one product, and that's all they do for like thousands of clients. It's horrible. And that's like their blue pill. Like that's what they give them. They're saying, this is the greatest, this is the best. And the people take their word for it and they buy it. And it's just frustrating because they make huge commissions. Like the commissions plus the overrides are like 10%. And so, but it's not the best for the client. And it's a good company for sure, but the payouts aren't as high and people don't know any better. And it's just frustrating to me as an advisor. I want people to be able to see everything. And as a certified financial fiduciary, I'm obligated to show you everything that's available. So anyways, I just kind of wanted to show you how this guy came up with his retirement strategy, how he came up with this plan, and it's a sound plan. Okay, you might have a different idea for how you want to do things, but for him, he wanted safety, he wanted some market growth, and he wanted a lot safer way of achieving his income goal, and he did it through allocating half of his portfolio balance to an annuity contract. And you can do it too. Go to my website, johnstevenson.com. You can plug in the numbers for yourself, and then when you're comfortable, you can reach out to me. Okay, there is a link right there. You can book a call with me. It'll be a Zoom call, and we'll look at my screen. I'll show you the numbers based off of whatever your personal situation is. If you're married, it'll be different numbers. If you're different age, it'll be different numbers. Different deferral periods are, change everything, change all the recommendations. But I work with all of these companies. Okay, I know the ins and outs of these contracts. And so I really think it's important for you to be able to have that transparency and that professionalism, especially when you're looking at something as important as lifetime income. So anyways, I hope that helps. I appreciate you watching. If you like the video, make sure you like, subscribe, share, and we'll see you next time. Hey, I really appreciate you watching the video today. If any of it makes sense to you, or if you found value, or if you even got a question about anything, I hope that you'll go to the comments section and ask it. There's no stupid question, and I'm looking forward to hearing from you.